Your company extends credit to its customers and allows for sales on account. Currently, there is a balance in accounts receivable of $50,000. These are customers that have purchased goods or services from our company, but have not yet paid for them. Will we get all of that $50,000? What if we don't? There are two ways to handle customers that do not pay you. One way is to wait and see if an individual customer is not going to pay. The other way is to make an estimate of what you think you will not be paid out of all the sales on account. The first way is referred to as the direct write-off method. The second way is referred to as the allowance method. With the direct write-off method, we wait until we determine a specific customer account is uncollectible. We have $50,000 in accounts receivable. Part of that balance contains I'm a debtor's account of $1,000. This account has been outstanding for 5 years. We've made attempts to collect the money and all of our attempts have failed. We have decided this particular account is uncollectible. Therefore, we want to write this account off. To do so, we would debit bad debt expense for $1,000 and credit accounts receivable for $1,000. With the allowance method, we would estimate how much of our total credit sales or accounts receivable we think will be uncollectible. We do not identify specific accounts that we think will be uncollectible. Rather, we make an estimate of how much in total we think will be uncollectible. For example, say we estimate that $5,000 of our $50,000 balance in accounts receivable will not be collected. We would set up an account for this amount that we think will be uncollectible, called allowance for doubtful accounts. This is a contra asset. Therefore, it is increased by a credit. We would make an entry to debit bad debt expense for $5,000 and credit allowance for doubtful accounts for $5,000. The difference between the balance in accounts receivable and the balance in allowance for doubtful accounts is called net receivables. This amount is how much we expect to actually be paid. However, the allowance account is just an estimate. More or less than what is estimated may be uncollectible. This amount is adjusted at the end of each fiscal year. This account is not only an estimate of what we think will be uncollectible, but is used when we find a specific account that is uncollectible. Let's go back to our customer, I'm a debtor, that never paid that $1,000 account. We've determined that particular account is uncollectible. Using the allowance method, we still want to write that particular account off, and we have the allowance account ready for any write-offs. We would debit allowance for doubtful accounts for $1,000 and credit accounts receivable for $1,000. What if the customer surprises you and pays you back later when you never thought they would, and you've already written their account off? Will you still take their money? Of course. Here are the entries we made to write off an uncollectible account under both methods, the direct write-off method and the allowance method. When you receive funds from an account that was written off, you will debit cash and credit whichever account was previously debited. For the direct write-off method, that means we would debit cash and credit bad debt expense. For the allowance method, we would debit cash and credit allowance for doubtful accounts. Although we'd rather have the money, now we know what to do if customers don't pay up.